How do at-the-money, ATM, call options compare to covered calls? Have you ever wondered how at-the-money call options stack up against covered calls? Let's break it down in simple terms. At-the-money call options are contracts where the strike price is equal to the current market price of the underlying stock. This means if the stock is trading at $20, your at-the-money call option also has a strike price of $20. Buyers of these options are hoping the stock price will rise above that strike price to make a profit. On the other hand, a covered call is a strategy where an investor owns the actual stock and sells call options against it. For example, if you own 100 shares of a stock, you can sell one call option contract, which typically covers those 100 shares. This strategy is called covered because you own the stock that backs the option. Now let's talk about ownership and risk. Buyers of at-the-money call options do not own the underlying stock. Their risk is limited to the premium they paid for the option. If the stock price does not rise, they can let the option expire worthless. However, if the stock price increases significantly, their profit potential is theoretically unlimited. In contrast, covered call sellers own the stock. This means their risk is tied to the stock price's decline, but they also receive the premium from selling the call option. Their profit is capped at the strike price plus the premium received. If the stock price rises above the strike price, they must sell their shares at that price, potentially missing out on further gains. When it comes to market outlook, buyers of at-the-money call options usually have a bullish view. They expect the stock price to increase beyond the strike price before expiration. Conversely, covered call sellers typically have a neutral to moderately bullish outlook. They aim to generate income from premiums while holding the stock. Let's not forget about income and profit potential. Buyers of at-the-money call options pay a premium and profit only if the stock price exceeds the strike price by more than what they paid. Meanwhile, covered call sellers receive the premium upfront, providing immediate income. However, their profit potential is limited to the premium plus any stock appreciation up to the strike price. At expiration, the differences continue. Buyers of at-the-money call options have the right but not the obligation to buy the stock at the strike price. If the stock price does not rise, they can simply let the option expire. On the other hand, covered call sellers are obligated to sell their shares at the strike price if the option is exercised. This could lead to selling the stock at a lower price than the market price if the stock rallies. In practical terms, traders use at-the-money call options when they want leveraged exposure to a stock price increase with limited capital. Investors use covered calls to generate additional income on stocks they already own, especially in sideways or mildly bullish markets. In summary, at-the-money call options are standalone bullish bets on a stock's price rising, while covered calls combine stock ownership with selling call options to generate income. Each strategy serves different purposes and has its own risk and reward profiles. Understanding these differences can help you make informed decisions in options trading.